All right, hello everyone, and welcome to the Sunbird FX Market Madness webinar. I'm sorry we had a small audio problem, but hopefully everybody can hear me now. Now, for those who can't hear me, I'm gonna this webinar is recorded, and it will be available in our website for all of you to review it. Okay. So again, this is the course itinerary. We're reviewing our third course, which is part 2 of minimize losses and maximize profits, expectations, and knowing when to open positions. Remember, I'm going to start with reviewing a few things in our last courses. I'm gonna break for a second. I'm gonna give a small 5 to 10 minute break to ask any questions so that I can hopefully answer all of them. And yeah, and let's begin. All right, so maximizing profits and minimizing losses, part 2. Okay, so let's have a small review of the course. What I did is that I know some of you asked me to have a template done for the trading plan. I'm just going to give you a first step to what you need to have in your trading plan. Okay, so here is a small example. All right, so you have your first currency, your second currency, your third currency. As you already know, in our last course, I told you exactly that it's best to choose at least 3 currencies to trade in. Not all currencies, because it's not worth it. You don't have enough information to know what's going to happen in the market. But 3 currencies are more than enough, okay, for a normal account. Now, remember that, again, what we reviewed in our course is that you need to set up your lines, you need to calculate your averages, set up your indicators, write all the results. Again, writing is very, very important. This is the key to successful trading. Analyze the currency of the previous day, current day, and the day after, like I said before in our previous course. Review all fundamental analysis. Write a summary of the market's currency. Write your expectations of the market's currency. Okay, so you write exactly what you expect. You have a summary of the market's currency, and you write all possible positions. By the way, you will need to choose, like I said before in our previous course, you have a target of how many trades per day you're going to open. All right, write your possible positions. Write positions. Let's say you on the first currency you choose 3, second currency you choose 4, and on the third currency you choose 3. Let's say. Okay, so just write all possible positions and then you choose where to put them. Again, so I'm just simple. It's a simple analysis of the trading plan when you, for example, when you analyze the market. So as you can see here, I put all my 3 indicators. These indicators we'll see later on. Some of them you already know. Okay, so what I did is that I analyzed my indicators starting from this line, as you can see. All right, this was my start of the day. I put my both lines. I'm calculating the average. I should have put a line here, but we'll review that later on in our second strategy. I'm reviewing exactly what my 3 indicators show, but this is very quickly and simple. Okay, so I'm just showing you again. I'm sorry that it's a bit blur. All right, but I'm just going to read everything. Okay, so this is an example of a simple template of the trading plan. All right, so okay, so you have the currency, which was the Euro US dollar. As you can see here, I decided to open 3 trades. Okay, so X lots per trade. So I said, so let's say let's say I'm opening 1 lot per trade. So I'm opening 3 trades, 1 lot per trade. What's my high? I wrote down my high, which is 1.35688. My low and my average. Which is resistance plus support divided by 2. I call it average 1, AV1. Now AV2 and AV3, this is today's course. Like I said before in our previous course, that there's a reason why I call it AV1, average 1. All right, average 2 and average 3. We'll review it today. I put my first indicator showing overbought at 1.35117, expecting a fall of the market, etc. You can write down a lot of things. Second indicator shows me a big jump in the market. As you can see here, there was a big jump in the market, and the second indicator showed it. All right, my third indicator shows a big movement upward in the market. So as you can see here, I'm analyzing my my graph. All right, and I'm writing down that my third indicator shows a big movement in the market moving upward. Okay, so again, just writing a small summary of the market data. The currency was moving to a downward trend from February 1st, and now it could be a possibility of a big correction as seen today. Possibility of an upward. Just by the way, I'm just cutting here. This is an analysis that I did yesterday, so I just moved in today. For those of you who want to learn a bit quickly on yesterday's market. Again, I'm just giving exactly all the information I have. So the currency was moving to a downward trend from February 1st, and now it could be a possibility of a big correction as seen today. All right, so yesterday I saw a big correction, so this is what I wrote. Possibility of an upward trend from what is seen from two of my indicators in the near future. Mixed data from the U.S. Okay, so this is exactly I would say the market. This is what I did here. The currency was moving to a downward trend. Is basically my analysis. Okay, so my first indicator showed me this, my second showed me that, and my third showed me that as well. And I wrote down everything in written down. Now I'm giving my market data. Mixed data from the U.S. only encourages more euro buying, so euro will go up. Euro USD pushing to a high very close to 1.37 after marginal upward revision to Eurozone manufacturing PMI on Friday, even if the 11-month high at 47.9 remains stubbornly in contradictionary. Okay, territory, wondering for France, yada yada. There was an upward revision to its shockingly low 42.9 flash release. Germany kept its end up with a drop in unemployment, minus $16,000 versus $80,000 exponential, and the final manufacturing PMI at 49.8 from 48.8 flash. The euro did hit a slight obstacle on Friday as the ECB revealed a 3-year LTRO repayment. This will LTRO will understand that later on in our fundamental analysis, by the way. Replacement or just Euro 3, 484 billion, etc. Now, don't worry about indicators. All right, we'll review that later on in our program. Nothing to worry. This is just a template of the what should be seen in a trading plan. Okay, so expecting the euro to move upward from this. So this is a summary. So what exactly am I expecting? I'm expecting the euro to move upward from what we saw in our indicators and from the news expectations. Needs to follow the plan. Okay, position details. This is my possible positions. Long at rate, as you can see, it's a rate that I choose. So let's say I'm choosing a simple rate. My stop loss, I have to write it down in my rate, and my take profit, I have to write it down in the same rate as well. So you see, so I'm writing down everything. Everything is in place. I can open my trade after I have this on one currency only. It's very simple. It'll help me a lot. Okay. Okay, so again, review of our last strategy, we use support and resistance. Okay, so exactly what do we need for our first strategy using the basics, calculating resistance, which is our highest rate of the day, calculating support, which is our lowest rate of the day, calculating the average, which is average 1, high plus low divided by 2. If it passes through resistance, go long. If it passes through support, go short. Write down your positions before opening trades. Remember, this is very important. Since it's the key to trading, all right, I'm going to repeat that every course. On every course, I'm going to repeat that sentence because it's very important. And if you do not open trades, if you do not write down your trades before opening them, your risks of losing money will be very high. Okay. So we're going to start our second course. All right, our second course is expectations, okay, which is part 2, our last part of minimizing losses and maximizing profits. So just understand that expectations are important since they're the first step before opening your trades. All right, you need to know exactly what to expect. All right, you need to write down, I'm expecting this currency to move upward or downward, etc., whatever it is. Write down your expectations. Expectations are very, very important simply because they minimize your risks. You don't need to open a position because you expect it to go up. You just need to write it down. Because if you write it down and it doesn't happen exactly at the millisecond after, it doesn't happen exactly as you expected, you just saved yourself a bad position. All right? So you just always write your expectations because you're minimizing your risk. So let's say you're expecting the market to go up. All right, you're going to open a position at a certain rate. If that position doesn't go at a certain rate, don't open that position, okay? Because it's not going as you expected. All right, so you're saving yourself a lot of time and a lot of money. It's expecting the movement of the market is very important because it's better trading. All right, it's a better analysis. You know what to you want to know exactly what to expect. And if it doesn't go from what you expect, all right, you have a plan B. Always remember, very important to have plan Bs. We're going to work on that later on. It's a step further of when to trade. It raises your chances of easy and profitable trades. Okay, expectations. If you expect the market to go up and it doesn't go up, you have plan B. All right. If it doesn't go up, I want it to go to plan B. If it doesn't go to plan A, eventually it's going to go to plan B. All right. If it goes to plan B, you're saving yourself not only money, but you're actually making easy money. All right. Expectations is another step to minimize your losses. All right. We're going to review that a bit later on during our course. Okay, and it's better for you because your position will be much more clearer than ever. Okay, so what I'm going to do is that I'm going to teach you exactly what is the XBT strategy. I called it the XBT strategy simply because it's a strategy based on expectations. All right, so the XBT strategy is a bit more complicated than the basic strategy. All right, nothing to worry about. We're going to go slowly on it. All right, I'm gonna cut 5 to 10 minutes to verify that everything is okay. If you have any questions, so I can answer them and then review again what I said before. So that everybody can grasp the idea of the XBT strategy and they can actually perform it in action. Okay. It assures you on how to minimize your risks, like I said before. All right, having expectations on trading and get you easy profit. It's a very easy profit. Remember, XBT strategy again. It stands for expected strategy. All right, so expected market strategy. All right, the XBT strategy works on normal volatility of the market only. Okay, if you use this strategy on an upward trend, it's not going to work. I'm telling you in advance, and I'm going to show you an example. All right, and then you're going to understand why you cannot use it in a upward or downward trend volatility. Okay, This strategy, again, remember, it's not 100% accurate. It assures you minimized losses. All right? I'm going to assure you that we're going to work on Plan A and Plan B. Okay? Plan A and Plan B will assure you more than 60 to 75% 75% profitable trades. Okay? Because if you have a Plan B, all right, there's no way that you cannot make money. Actually, there's no actual way that you can actually lose money. All right, we're going to work on that. Okay, so let's see again. What are the tools for the XPT strategy? All right, so again, we're going to use a bit of basics. We're going to calculate our resistance. We're going to find our support. We're going to calculate our average 1. We're going to calculate our average 2. So what's our average 2? Remember, if those of you who want to write a few notes or anything like that, average 2 is the resistance plus average 1 divided by 2. Calculating average 3 is support plus average 1 divided by 2. All right, so I'm just going to show you a graph on which I used my my averages, my resistance, my support. So I'm just going to show you this. All right, so this is on the normal volatility of the market. As you can see, it goes up and down, up and down, up and down. The thing is that some of you, a lot of traders are very afraid of this because they can open a position and then it can go wrong. I'm going to show you exactly how to open this position with a small strategy. Remember, we didn't get to the best part yet. Okay, I'm just showing you basic strategies. All right. Later on, I'm going to show you strategies that will actually blow your mind. All right. But first of all, what you need to do is that you will need to understand exactly what we're looking at. All right. You will need to understand basics before going into to more complex strategies. All right, so just a moment. I'm just going to figure out if I can zoom in a bit so you can see a bit better. Just a moment. All right, sorry guys. Unfortunately, I can't zoom in, but I'll tell you exactly if you can try to maximize your screen. All right. Now, as you can see here, all right, this is the 5th of February. So it was yesterday. It was taken yesterday. I'm just going to show you a small example of the tools that I need. Sorry. All right, tools that I need in order to start my strategy. Okay, so calculating resistance and support. All right, so here you can see resistance. All right, and here you can see support. Resistance is the highest level, the highest rate of the day. All right, and support is the lowest rate of the day. Remember, the start of the day is 5, the 5th of February. All right. Okay, let's go back. All right, so I have my resistance, I have my support. I need my average 1. What's my average 1? Is resistance plus support divided by 2. As you can see here, average in the middle, you're going to see 0.99831, the rate, average resistance and support, AV1. Okay. Now let's go back. Next, we need to have calculating average 2, resistance plus average 1 divided by 2. All right, so average 2, resistance plus average 1 divided by 2, which is average 2. All right, so here we have resistance, here we have average 1, and here we have average 2. Now calculating average 3 would be support plus average 1 divided by 2, we have average 3. Okay? And I'll explain exactly how to set up your strategy. Okay? So now you have all the tools inside. Great. Wonderful. Now we're going to start our strategy. Remember to write down your results. Okay? So first you have your resistance. Write it down. What's the rate? Support. Write it down again. Average 1, average 2, average 3. Write it down. Okay, so let's start. Let's start with the strategy. Okay, the strategy is separated in 3 steps. Okay, so you have your first step 1 is you have your first expectation, second and your second expectation. All right, so your first expectation is very simple. Okay, remember you need to write it down. Okay, you need to write down what are your 2 expectations of the market. Okay, so let's go back to our graph. All right, so here we have the start of the day. Okay, now we have our first expectation. What's our first expectation says? First expectation: if market goes above average 1, expect it to go down, meaning short. All right, so let's see. If it goes above average 1. All right, so first of all, it went above average 1. It went down, whatever. We're not going to count it because not a lot of people trade during in the middle of the night. All right, so let's say, okay, here. Went above average 1. All right, so I'm expecting it to go down. I'm expecting to open a short position. Now, the question is when to trade. I'm not going to open a position right now because I can start losing, but I want to minimize my losses and maximize my profits. Remember. Okay, let's go back. Oh, sorry. Okay, so first expectation, market goes above average 1 as we saw here. Now, expect it to go down. So right now I'm expecting the market to go back down. All right, so when to open a position, okay? You need to be set to open a position when the market breaks average 2 or average 3. All right, so let's go back. Okay, so it went above average 1. This is like my first expectation says. All right. Now, when to open a position? I'm not going to open a position right now. I want to wait. I want to profit from it at a maximum interest. All right, so I'm waiting for it to break average 2. It broke average 2. Now this is my chance to open a position. All right, let's see what it says here. Open position after closed rate and at the end of beginning of the new rate. Depends on the time frame of the chart. Remember, okay, some of you will ask me, Adam, what time frame are you using? On normal volatility time frame, I would prefer using 30 minutes. Okay, 30 minutes is best. All right, so let's see. It broke average 1. All right. So it's above average 1. I'm expecting it to go back down, right? Okay, but when to open a position? When? Step 1, when it breaks average 2. All right, it broke average 2. Now I'm set to open a position. All right. It went again high. It almost broke my resistance. If it broke my resistance, we go to the basic strategy. All right. It almost broke through resistance. Not yet. Okay. It's starting to fall down. Second rate. All right. I'm looking at it. It's starting to fall down. Open your position right away. All right. Even if it's going to go back up. All right. As you can see here, you open your position at the closed rate at the beginning of the new rate, and as you can see here, it went back down. All right, very easy. All right, you're using a lot of tools for it, but it's profitable. It's easy money. Okay, so again, let's redo this. Okay, so here we have the market going above average 1. All right, I'm expecting it to go down, but I'm getting set. I'm setting up myself when it breaks through average 2. So It broke average 2. All right. I want to open a position. I'm set to open a position. I'm waiting for it to close the first rate. So it closed here. Open your position. I opened my position, went back up until the support. Okay. Now, now that it went through support, all right, I'm almost done. Okay. Actually, you know what? Even better. I'm going to stop here because after that, we can have a second, we're going to use our second expectation, all right, which is if market goes below average 1, expect it to go up long. I'm going to stop here. I'm going to give 5 to 10 minutes to ask any questions, and I'll gladly answer them. Hopefully, I'll answer all of them. Feel free to ask whatever you want, starting from now. All right, so let's see what questions we have. Okay, the resistance of the graph has been put after your example around 6:30. Okay, listen carefully. Okay, when you, again, from our last course, we said you wake up in the morning, let's say at 9 a.m., at 10 p.m., you look, okay, maybe right now the resistance, okay, is not the same as here, but it's very slight. Okay, as you can see, the resistance, as I showed you here, is at 0.99946. All right, and the resistance that should be put in is 0.99940. It's a difference of 0.04 pips. Okay, so it doesn't matter. One way or another, it broke through the average through my resistance and support. Your support also, it's going to be even more profitable, okay, if the support here, okay, the support, I took it exactly at 2. So if you look at 2, all right, the support is not the same. At 2, it's not the same as at, let's say from 2 to 10. 10 a.m., the resistance should be around between 0.99740 to 99760. All right, so you can change the resistance. Remember, you need to use basics first, all right, before you even start trading. Okay, so you use basics, and then you set up your lines, and then you write down everything like I said before, and then you can open your trades. Again, just reminding you, the webinar is recorded. So let's hear our second question. Okay, so when I talk about normal conditions or normal volatility, all right, it simply means that you cannot, we have a question here, what do I mean by normal conditions if London market, first of all, it's any market, okay? You need to understand that this strategy is on normal volatility. When I mean normal volatility is when you do not see an upward trend. Let's take, for example, the Euro CHF or the euro US dollar, you're going to see there's a lot of upward trend. Sooner or later it's going to stop. All right, it's going to be on a normal volatility, nothing to worry about. All right, but on normal volatility, the EXPT strategy works, not on upward trend when you're going to see that the market is moving upward all the time or downward all the time. So we have another question. Is there a tool or indicator which will do this calculation? It's a very simple calculation. All right, you can write it down. I can give you the calculation. There's no indicator. It's a strategy formed by a team of experts, my team of experts, myself as well. It shows a lot of profitable trades. I traded with that as well. It's an amazing strategy if you can use it properly. All right. If you cannot, if you're having trouble, for sure you can send me an email or ask me to contact you with pleasure, and I'll work with it with you. All right. So we have a question. Reminding you, I took the analysis of the support at 2 p.m. All right, but it doesn't change anything, and I'll show you why later on. If let's say you woke up at 10 a.m. all right, and you're putting your lines at 12. All right, just look carefully. Your support will either be a bit less than 0.99760. All right, but as you can see, it broke. All right, so already could have made a small support a profitable trade on support, close the trade after 20 pips, all right, and then go back up. Okay, so remember, the support, remember, you just need to start basics, put your resistance, put your support, put your average 2 and average 3, and then put all your expectations. All right. Now, we have another question, is how do we know that this is not a trend? Okay, a trend goes from, how can I explain a trend? It's very simple. It's like stairs. If you can see that the market are doing like stairs, but only stairs and nothing going back down or back up, as you can see, it's going, let's say on an upward trend, you're going to see stairs that go only up. Very rarely that goes down. Normal volatility is when you see that the market goes up and then goes down and then goes up and then goes down, etc. Okay. Let's see our next question. Okay, concerning the change of support, remember, yes, all calculation will be changed, of course. Remember, I took my resistance and support at 2 p.m. Remember, don't worry about it. Do not freak out. All right, I can take my, I can do my analysis whenever I want. You can do your analysis whenever you want. As long as you analyze the market correctly, you can trade. All right, I'm going to show you after that. Let's take, for example, all right, let's say I took it at 2. All right, at 2 would be most convenient for me to show you my calculation. All right, so I took my support, my resistance, I put my average 1, my average 2, my average 3. All right, and then I'm going to do my second expectation. My second expectation, you're going to see it later on when I finish answering the questions. All right. Okay. So let's continue. Okay, so at the moment what I showed you is our first expectation. What is our first expectation? It's simple. If market goes above AV1, average 1, expect it to go down, meaning expect it to go short. All right. Step 2, when to open a position. When should I open a position? I open a position when it breaks through average 2. All right. In this case, okay, it's average 2. If it breaks average 2, get ready to open your trade. All right. Now, when you open precisely your trade, when the position, when the rate is closed and you have a new rate. Let's review it very quickly. All right. So again, here at the beginning, do not worry, do not freak out. All right. It passed through the average. All right. Broke average 2 and then went average 2. Okay. Second rate. All right. Went back down. All right. Why am I telling you to open a trade after the closed rate? Simply because to reassure your trading, meaning that I want that your position will be under profitable trades. If, let's say, you open a short position, all right, before closed rate, and it goes, and it jumps through, and it passes through your support, it's a trade that is lost. Okay, you do not want that. So what you're going to do is that you're going to wait till the second position open, the second rate opens, and you're going to open your trade when it opens. Okay. Let's do our second expectation. All right. Second expectation, if market goes below average 1, expect it to go up, to go long. All right. So here it went back down. Okay. Let's say now, as you can all, as some of you are commenting on the time frame or the time that I took my my calculations. Let's say I took it at 2, as you can see here. All right, at 2. Okay, let's say at 2 I set up my lines. All right, it's below average 1. All right, I'm expecting it to go back up. So if it passes through average 3, again, if it breaks average 3, and it already broke, all right, expect it to go back up. I'm expecting it to go back up. All right, when? No, again, let me repeat that. Sorry, like I said, it's a bit complex. All right, but if you can grasp the idea, you're going to get it. All right, it went below average 1. All right, so I'm expecting it to go back up. All right, now when should I be ready to open a position? Right here. Okay, so when it breaks through average 3, okay, it broke through average 3. I'm getting myself ready to open a position. All right, I'm waiting for the rate to be closed. Remember, the rate is not closed. Is not closed yet. All right, broke through. All right, I'm opening a position at the second rate. All right, opening position, going back up. All right, now that it went back up, again, it passed through the average. I'm expecting it to go back down. All right, when to open a position, so I'm setting myself, if it breaks through average 2, open my position. It broke through average 2. I'm getting myself ready to open another position. When it broke through average 2 and it went to a new rate, let's open another position. Okay, so I opened another position on short. All right, it went back down, and it does that all the time. Okay, so let's review again our first and second step. First step, you have your 2 expectations. Your first expectation is, if market goes above average 1, expect it to go down. All right, second expectation, if market goes below average 1, expect it to go up. All right, so meaning long. Step 2, when to open a position. All right, so if, let's say, market goes above average 1, so you're expecting it to go back down. All right, you get ready to open a position when it breaks through average 2. When it breaks through average 2, all right, you're getting ready for it. It's passing through a new rate. All right, so the current rate closed. We have a new rate coming up. When the new rate opens, open it. Open short. Okay? Second expectation. If market goes below average 1, expect it to go back up. So let's say it was below average 1. All right, so I'm expecting it to go back up. When to open a position? When it breaks through average 3, getting myself set up to open a position. When the rate closes and the new rate is coming up, I'm opening my new position on long. And you're going to get the result. All right. Step 3. Now we have our strategy. We have our position opened. Now where to put our stop loss and where to put our take profit. All right. Very, very simple. If we follow our first expectation, all right, stop loss will be the resistance rate and take profit will be average 1. Let's see. Okay. Our first expectation tells us if market goes above average 1, expect it to go back down. Let's go back to our graph. Market goes above average 1. All right, expecting it to go back down. All right, it broke through average 2. Past my new rate, so I'm opening my position. My stop loss is the resistance here. So I'm minimizing at a maximum rate my losses, if I have any. Taking profit at a maximum rate, because it's going to go back up, and I don't want to miss the opportunity of profiting from the trade. So I'm taking profit here, average 3. All right? Now, let's take, for example, our second expectation. It's the same thing, only vice versa. If market goes below average 1, expect it to go back up. All right. Again, so market went below average 1. All right, I'm expecting it to go back down, but I'm waiting for it to go a bit downer. All right, so it breaks through average 3. All right, I have a new rate coming up. I'm opening my position. My stop loss is my support, and my take profit is average 2. As you can see, it went through average 2, went again. It closed the rate and then it went back down. I want to profit from this position at a maximum rate. Remember that. Okay. I closed the position. Again, I'm doing that. All right. Later on in our next course, I'm going to teach you. I'm going to do a full review of this course of part 1 and part 2 using a small thing I call pending orders. As you can see, sorry, I'm just going to go back. In our itinerary, pending orders, definition, and basing them as strategies. I'm going to teach you that so that you don't need to break your head too much. Only for 1 hour, all right, maybe half an hour, maybe even 15 minutes, all right? We will need to concentrate as much as possible, and then we need to set up our pending orders so that our position will be opened automatically. Remember, it's a bit complicated to understand. It's totally normal, all right? But we have a webinar tomorrow for the same course if you want to participate, okay? And I'm going to, this webinar is recorded, and we're going to put it in our website. So nothing to worry about. You can pause myself, you can fast forward myself, whatever you want. Don't worry about it. Just try and stay concentrated on what I'm telling you right now. Don't worry, everything will be fine. Okay, so again, we followed our second expectation. All right, if it goes below average 1, I'm expecting it to go back up. All right, so it broke through average 3. Remember, average 3 is support plus average 1 divided by 2. Broke through average 3. We have a new rate. I'm opening my position on long. Went to long. My stop loss is support. And my take profit is average 2. Okay, I finished it, doing the same thing, calculating. Okay, so I passed through the average. All right, it broke through average 2. I'm expecting it to go back up. I'm getting ready for it. Went to a new rate. I took profit on my last position. I'm opening a new position. Open a new position, goes back down. All right, and taking profit at average 3. All right, so already 2 positions for sure. These 2 positions are profitable trades, and you're minimizing your losses at the lowest level. Okay. All right, so let's have a small review of the course before I give out a competition. Remember to write down everything. All right. If you do not write down everything, if you do a small analysis of the market like that, all right, I'm telling you in advance, you're not going to make any profit. All right. That's why I told you to write down everything. Write down your averages. Write down your average 1, average 2, average 3. Write down your resistance and support. Everything. Write your expectations. Exactly like I said before here. All right. First expectation. Write it down. All right. Don't worry about it. It has to be on your trading plan. All right. Next to your trading plan, you need to have a list of what strategies you're going to use. Okay. All right. Calculating average to average 3. Write your expectations. Expectation 1 and 2. Set your position. All right. So I'm getting set. I'm setting up myself to open a position, like I told you, when the market rate closed. All right. And then you open your position. Remember that this strategy works on normal volatility of the market, normal volatility only. Okay? This strategy will not work on high volatility, upward on downward trends. Okay? Remember, try to review this lesson on our website, okay, at www.sunbirdfx.com. All right. Go on education. Click on education at the top left of the website. All right. And then you're going to go. You're going to see webinars. Click on webinars. You're going to see the latest webinar. All right. Click on it. Review the full course. Don't worry about it. Okay. For those who need the steps for the strategy, all right, you can contact me at info@sunbirdfx.com or adam.williams.fx@gmail.com. All right, so I'm going to write it down in the chat so that all of you can have it. Okay, so get ready for the competition, everyone. All right, competition 101. All right, we're going to use this strategy to the client. Using this strategy, the client that shows the most profit will win. Okay, so first of all, he will win one-on-one course of the latest strategy and analysis for myself, assured profit. Okay, I have a list of strategies that work almost 100%. All right, most of my clients, all of my clients are profiting from these trades. They choose what strategy they want me to teach them, and I teach them. I teach it to them. I show them everything. I will be guiding them on a one-on-one course, all right, to a very big successful trading. Not only that, I'm going to give out $150 bonus, all right, in your account. All right, you will even also be withdrawing that bonus if you're a winner. Okay, so remember, using this strategy, you will need to show me exactly the client that shows me the most profit using this strategy only gets the winning prize. Next, remember, don't worry about it. If a lot of you could do this competition, all right, some of you can even win iPads, etc. Don't worry about it. Okay, so instruction to enter the competition. To enter the competition, you will need to send me an email to info@sunbirdfx.com with number 1, your account number. All right. Number 2, your full name. Number 3, the competition code, which is 101. All right, and ticket number 4, ticket number of every position you're using the strategy. So if, let's say, you're using this strategy on the US dollar, Canadian dollar, for example, all right, you open the position and you will have your ticket number on the trade that you opened. All right, that ticket number, every time that you open a position, you need to send it to me with the competition code, your account number, full name. All right, so that's it. All right, so may the best trader wins. All right, thank you very, very much for entering the webinar. Remember, this is not for demos. This is for active accounts. Again, thank you very much for coming to this webinar. I hope you liked the webinar. The winner of last week's competition is not set today. It's for tomorrow. So I'm just giving another day in advance. For those who want to enter the competition, the code is B100. Okay? Now, so again, thank you very much. If you need to contact me, you have my emails. Thank you. I hope everybody enjoyed this webinar. I'm going to give again this webinar tomorrow. So if you want to attend, if you want to understand better, please come to tomorrow's webinar as well. All right. I'm going to record my sessions again, and I'm going to give, and tomorrow afternoon, I'm going to upload the video on the website and on YouTube for those who want to enter on YouTube. Again, thank you very much for coming, and hope you enjoy your day, all right, and have a wonderful trade. Thank you very, very much. Webinar tomorrow again. We have a question. Webinar tomorrow is the same time. Okay, thank you very much. Have a pleasant day, night, or morning.